Do you know how banks make money? They loan out the money you deposit into them to companies, governments, and individuals and get paid from those borrowers interest. But all of that money goes towards their profit and expenses. And by depositing your money into their checking and savings accounts, you can earn some interest for yourself, but it's not that high. For example, one of the largest banks, JP Morgan Chase, will give you 0.01% on your deposits. There are some online banks offering higher rates, such as SoFi with 3.75%. However, let's just cut out the middleman entirely and do it ourselves. And let's loan it out to one of the safest borrowers there is, the US government. By the way, I have included timestamps below, so if you want to just skip to the tutorial part, you can just go to this timestamp. And if you want to watch the whole video, which I think you should, you can do that too. But if you already know everything there is to about bonds, you can just skip to wherever timestamps that you're interested in and back to the safety of US government bonds. So you are basically guaranteed your money back plus profit. So unless the US government goes bankrupt, which is very unlikely and would kind of destroy the entire financial system we have in the world right now, you are guaranteed your money back. Plus the profit that you make, you don't have to pay state or local income taxes. So if you live in a high income tax state, doesn't matter. You don't have to pay any taxes on that with letting the US government borrow your money. So let's go to Treasurydirect.gov, which is an official website of the United States government to look into bonds, which is a fancy term for debt that the US government will pay you back. So if you go to auctions here and then look at recent auction results in the 20 most recent auctions, if you let the US government borrow your money for 4 weeks, you can get 4.568% interest for yourself, all profit. So instead of the 0.01% from Chase, you can get 4.568%, which is 456 times the profit that you have otherwise received. And then if you let the US government borrow it a little longer for 8 weeks, you get 4.6%. And then 17 weeks is higher, 13 weeks is lower. So let's talk a little bit more about what bonds are. Bonds are debt issued by companies or governments to raise money. They can be used to finance government spending and manage the national debt. So these bonds are basically sold to the public by the US Department of the Treasury, and the money received is used to fund government operations such as the military, Medicare, Medicaid, Social Security, healthcare expenses, and other things. So you, as a citizen or as any person who's of legal age to buy investments, can buy those bonds in return for the principal and interest. If we want to take a look at the US national debt, it stands at $31.4 trillion. So that's the amount of money the US federal government has borrowed and needs to pay back to people or companies or governments. And if you break that down a little bit more, you can see that most of that money is owed to other branches of the US government. So the largest holder of US Treasury securities is the federal government, followed by foreign governments, mutual funds, depository institutions like banks, state and local governments, pension funds, insurance companies, and then other stuff. So of that 40%, 2.71 trillion of that is to the Social Security Trust. So how does this work? Well, Social Security takes in revenue from payroll taxes, and that amount of revenue they receive is greater than the amount they have to pay out to recipients, because more people are working than there are people who are receiving Social Security. And that excess money goes into buying US government treasuries. But as more people retire and birth rates slow, the amount of Social Security revenue to payments will not be as balanced. So that's why in the future we might run out of funding, meaning the government won't be able to pay as much in Social Security as they pay right now. And the next largest federal agency that we owe money to is the Military Retirement Fund, which is 1.36 trillion. And if you want to look at the major foreign holders of US debt, Japan is the largest holder of US debt with $1.08 trillion. And then there's China, United Kingdom, and so on. Now, there are many different ways you can buy bonds. You can buy directly from the Treasurydirect.gov website. Just go to Treasurydirect.gov. and then log in if you already have an account, or create a new account if you don't have an account. And it's pretty simple. Just read through the instructions. So apply now, then, well, most likely you're an individual, but if you are a business, then set up a business account, then click submit, then type in your name, your social security number or tax identification number, and then your address and your email, and then your bank, and then check this, read this, and submit it. And then once you're logged in and have an account, you can click buy direct, and then click on bills, so short-term securities of 1 year or less, click submit, and then pick the one that you want to buy basically. So if we go back to the Treasurydirect.gov website, auctions, look at recent auction results, and look at the 20 most recent ones. So if we look at the 4-week security term, meaning that you're letting the US government borrow the money for 4 weeks, so it'll be issued on February 7th, and then it will mature, meaning you get your money back on March 7th, 2023. If you're comfortable with that, then that'll be about 4.568%. But these are for past auctions, while on Treasury Direct, you're buying future auctions. So this one will be on February 9th, not February 7th. And so this 4.568% investment rate is just an estimate based on a prior auction. This one will be slightly different because this is a future auction, but you can go on here and just look at the rates so that you have some sense of what the interest rate will be at. For example, the 8-week one, which is, about a month longer, gives you a higher investment rate of 4.6%. So if you want to lock up your money for another month, then might as well get the higher interest rate and get an 8-week treasury bill. And then you can look at all the other ones up to 52 weeks. But let's say you want to do it for 8 weeks. Well, you click here. Then if you want to schedule a reinvestment, yes, no, up to you. So as a real world example, I'm going to buy a 4-week treasury for February 9th, 2023. And the interest rate is going to be about 4.568%, give or take. Then you scroll down, you purchase at least $100. You can do any increment of 100, but it has to be 100 or more. Then pick the source of funds. So where is the money coming from? And then you have the option to schedule reinvestments. So once your 4-week treasury bill matures and the money is deposited back into your account, do you want it to reinvest again into the 4-week treasury bill or not? I'm going to click no, but if you had selected yes, you could have done that 2 times of reinvesting. Bills may be scheduled for reinvestment up to 2 years, but I'm not, so I'm going to click no. Then select a destination for the last maturity payment is going back into the bank. For me, because I'm not reinvesting it, click submit. Read through all of this stuff. Make sure your purchase amount is correct and the bank account is correct. Then I will click submit. And voila. So it will be issued to me on February 14th. You can also go into your current holdings and then see all of your current holdings and treasury bills. Or you can just go back to my account and get the current total. You can also go to Manage Direct, manage your account, for example, updating a bank account or adding a new one. And you can also manage your taxes and view any tax documents that you have. I personally don't like the user interface of Treasury Direct much, so I prefer to use a brokerage, which is easier for me to navigate, but up to you. I'm going to show you Charles Schwab, which is the brokerage that I like to use. So the link is in the description below, but you can make an account on swab.com or use my referral link if you want to. Then once you log in, you'll be on your account page, and then you can click Trade, Bonds, and then invest in the bonds that you want to trade. You can see that CDs are currently 4.62% for 3-month terms. US Treasuries are higher at 4.66%, so that's pretty good. So if you want, you can just click here, and then you can see the maturities for 3 months, April to May 2023, and the specific dates of them and their accompanying yields. But this is for prior securities that have already been auctioned off. If you want to buy new securities, you can go to new issues and then type in Treasury auctions. So there you go. And then you can see, so this one will mature in 3 months and 8 days from today, 6 months, 3 years, 10 years, 20 years, and so on. So if we click buy on this one, which is about 3 months away, we can see that this one matures again, May 11, 2023, and you have to buy at least $1,000 worth. So it's higher than Treasury's Direct $100 minimum. Then if you want to do an auto rollover option, you can. So auto rollover lets you instruct Schwab to automatically reinvest the principal of your maturing CDs and Treasuries on your behalf for new instruments when they mature, just like the reinvestment on Treasury Direct. And then it's a market order, so it will be placed at the price at auction, which we don't know yet, but we can estimate using the Treasury Direct website. Then click review order. You can see that there are no fees, just like Treasury Direct, and then you place the order. One thing that I want to let you know is that you have to do it during market hours. So for Charles Schwab, that's Monday through Friday, 8:30 a.m. to 6 p.m. Eastern Time. On Treasury Direct, you can buy it at any time, but on Charles Schwab, you have to purchase the order between 8:30 and 6 p.m., excluding federal holidays. And then if you go back to bonds, you can see previously issued bonds. So just click Treasuries again, and then search for the specific dates that you're interested in. But I'm just going to view the search results now. And you can click here if you want to order by yield to maturity. So this is the highest one so far at 4.836%, but it matures in about a year. So December 31st, 2023. So you have to wait a lot longer for your money. And if you click buy, this one, you can see an actual yield to maturity date because it's not a new auction. It's for prior auctions that have already happened. So let's give an example of how the math works. So bonds are sold at face value, also known as par value, or they're sold at a discount, and then the discount is the interest, basically. The interest can also be known as the coupon value. So we have an investor named John, okay? And he found a T-bill with a face value of $10,000 and a maturity of 26 weeks, which is half a year or 6 months, approximately. And the discount rate is 0.5%. So if you take the face value, 10,000, and you multiply it by the discount rate, so 0.5 over 100 because it's a percent, you get $50. But since it's only for half a year instead of a whole year, you divide it by 2 or times it by 1/2, and you get $25. So you actually purchased $9,975, and after 26 weeks, you get $10,000. So that $25 difference is basically your interest, your profit. So that's how a T-bill works. You buy it for less than the amount it's worth until the maturity date when you get all of it. So if you look at Schwab here, you can see that the purchase price is $98.72. So not $100, but $98.72. So that's at a discount. And that discount, if you do all the math over 1 year, it'll get you 4.665% interest. This one that matures on May 4th, 2023 has a price of 98.90. So the discount, if you do all the math, will be 4.641%, and that's how much interest you'll get. However, some bonds, you get coupon payments or interest payments. So let's say that you have a 5% coupon for a $100 bond. So then as the bondholder, you'll get $5 every single year. So you can buy it either at a discount and then get your interest at maturity, or you can just get it as part of a coupon. But T-bills work by doing a discount. Other bonds work by giving a coupon. There's just two different ways to get paid. So here you can see that the coupon rates are 0. So that means you get no interest payments. You only get paid once it matures on March 18, 2023. So this one has no coupon, but a lower price, giving a higher interest rate. This one has a coupon interest payment, but it costs more, and thus will give a lower effective interest rate. So you want to pay attention to the yield to maturity rather than this stuff here, unless you want to, but this is the most important. And then you can click here, and then you can order it by lowest to highest, or highest to lowest. So that's how you do it. You also want to pay attention to the minimum purchase amount. So all of these minimums are in $1,000 increments. So you have to purchase at least $35,000 worth. But if you don't have $35,000, then you can buy this US Treasury bill with a 4.662% interest rate. So only a 0.001% difference, but you can buy less of it and only $1,000. So that makes your life easier. So the minimum and maximum, pay attention to that, and the yield to maturity and the maturity date. This was a lot of material, so I made a part 2 as well for you to watch. It talks about how to cash out your bonds early, for example, if you need the cash now, so you don't have to wait until maturity, and other benefits that I didn't go over here, and other considerations that you should probably pay attention to. So please watch that video, which will be released soon, if not already. Thanks for watching. Please like, comment, subscribe. Let me know what your favorite brokerage is, and have a wonderful day.